good morning, Black Swan fans. So anyway, good morning. It's Friday, options expiration Friday. The market is open, so this is a normal options expiration Friday. So, um, so I just want to make sure that. Again, following this is for my advanced options course, and you're following along as I do real trades, and so that I can help you learn how to do options with less risk and with less problem and be profitable, hopefully. But again, these videos are for educational purposes only. Here we are, Black Swan Financial Advisors, my website, my YouTube channel. Please subscribe. And my email, if you'd like to send me an email and talk about anything. So let's jump right into it. The market just opened. It's 6:32. And so let's just see what's kind of happening here. 6:32. If this thing will load. The futures were open and now it's open. So the market's up today. Actually, pretty good. It's been down most of the week because of the Fed, right? Job reports. That inflation, man, it's really sticky. It's going to be really rough because the Fed's got its target on inflation, and one of their key measurements has to be that unemployment number. And so unemployment actually went down. So here we are paying $5 for a dozen eggs. I'm paying $5 or more for a gallon of gas. But the unemployment rate is the lowest it's been in like 40 years or whatever. So anyway, let's jump into it. So the market is up this morning. So that's going to be really, really interesting because I have positions that are both long and short, right? I have positions that'll go up when the stock market goes up, and I have positions that'll go up when the stock market goes down. And right now I'm in TLT. I've been in TLT for a while. Actually, I need to update this. SPXU, which is the triple leveraged ETF that is the inverse of the S&P 500. So I use that to hedge my long positions. It goes up when the stock market goes down, when the S&P 500 goes down, right? So let's just jump right into it. Expiration date today, and let's look at these ones first. Okay, so this is kind of my long speculative portfolio. You'll notice I own DocuSign and PayPal and SoFi, and you also notice that I've lost a lot of money in this account. I'm down $7,500. I mean, I got into these positions a few months ago, earlier in the year, but after the run up. And so what I've been trying to do is maybe sell calls on some of these positions so that I can recover some of the money, right? And make my cost basis go down. And then I do have an SPXU in here. So you'll see I own 500 shares of those. The market is up today, so you can see it's down. Okay, everything else is up. So my DocuSign, you can see here my cost basis was around 57. It was actually less than that because I sold a put to get into it. So 55-ish or so. And I sold a $60 call. The expiration date is in June. So I still have a whole month. So you'll notice, I mean, the price hasn't moved a whole lot. PayPal, the same. I have an $80 call for PayPal, which is over what I paid for it. So that's the idea of selling a call on something that you already own. Well, I want to capture some capital gains, and so I usually I like to do that with a strike price above what my cost basis was, above what I bought it for. Okay, and I mean, just think about it. If I buy this stock, PayPal, and I bought it for 75 because I sold a put, and then I make $1.50. Now instead of 75, my cost basis is 73.50, and then I do it again, and then my cost basis is 72, and then I do it again, and my cost basis is $70.50, and I can drive down my cost by selling these calls. But the downside would be that I've limited my upside by having this $80 call. If before this expires, come June, if PayPal is over $80, somebody's going to buy my shares for $80, okay, and they'll go away. And then I'll sell some more puts and get back into the position. These are kind of my long-term speculative positions in this account. So I had calls on Unity and Twillo and SoFi, but you can see that the current prices are so far from the price that I paid that I can't really I can't sell a call that really makes me any money. So let's just look at SoFi for a second. And if I go out 42 days, which is June, I paid $6. I paid about $6 for that. Okay. So I would want to sell a $6 call, but I can only get 15 cents a share, okay, per contract. So I'd only get $130, and I'd pay a commission, and then I would sell it if it hit $6, I'd sell it for $6. So I just got to watch this. If the current price gets back up over $6, then I'll be able to sell a $7 or an $8 call for like 50 cents or something. Okay, so I'm just going to watch these. The ones on Twillo and Unity expired last Friday, and I just took the money and my cost basis went down. So SPXU, now this is an interesting one. Again, this is the inverse. This goes up when the stocks go down, and so I own 500 shares. I actually want to own shares here because these will go up big time if the market crashes hard. So this is my hedge for my whole portfolio. Okay, so my cost basis on these is actually below $13, even though it says $14.67. I've been selling puts, and then I've been selling calls on these. So I'm going to sell a couple of calls on these. Maybe the price is $13.60. Usually the best time to sell a call on something is when the price is going up, and right now the price is down today. So I'll probably watch this, and maybe next week maybe I'll sell calls on 2 contracts, so on 200 shares, and I'll keep the other 300 shares naked for in case the market crashes. So let's jump back over to E-Trade and see where I'm at over here. Again, my long positions have not been doing that great. But here you can see this put. May 19th. It still has a couple of weeks. I sold it. It's a -3 contracts. So I sold 3 contracts, and I got $1.15 per share on $18 strike. So that means that my cost basis of that's going to be $16.85 if I get put this. Now I sold this. I want to get put this. So on May 19th, I'll either keep the $115 per contract, and I'll do it again, or I will get put 300 shares of BXMT. So I want to own BXMT. So my Caterpillar call here, that was a speculative, speculative call. I still have a few months to be right on that one, but you'll see my option has lost more than 50% of its value. So my cost basis on that was $375. If it goes up to say $270 or so, it'll have $10 of intrinsic value, so it'll be worth at least $1,000, and I paid $375 for it. Caterpillar right now is at 214. Okay, so that one's kind of under the water. Chances of that coming true might be kind of hard unless Caterpillar has a big rally. Now these are also speculative, but these are bets that the market's going to go down. This one, CrowdStrike, I got into this one yesterday. I bought a put again. So this one is in the money though. So look at this one. The strike price is at 135, and the actual price right now is 119.91. So 120. Okay, so let me explain that a little bit. 120. CrowdStrike, the current price is 120, and I have a put for 135. So if I sold this, if I exercise this right now, I have $15 of intrinsic value in this option, $15. So I would lose $3.50 per share, but this one still has value, and actually it's up. It's gone up. I paid $18.55 for it, and it's worth $19.45 right now. So if I sold this, I could close this, and I would, since I bought it, I would sell to close this if I was going to get out of it. So sell to close. Just want to make sure you guys understand the terminology. My Cisco put, I sold this one because I want to get into Cisco. Again, this is a long-term play out to June. I want to get into Cisco. I got a $50 put. Current price is 46, so price has gone down $4 since I sold it. I got $1.50 though. So my cost basis would be what's that? 48.45. So less than the 50, but a little bit higher than the current price. Okay, 5.9. This is another one that I bought a put. So these are, these are kind of bearish, trying to protect my my portfolio, my long positions, and you can see that one's up today as well. I paid $10.07. Again, this one is in the money. So 5.9s and CrowdStrike were in the money because the current price is higher than lower than the price that I paid. See, 59.26, and I have a strike of 65. So I have almost $6 of intrinsic value in this, and the rest is what's called time value. And then gold, GLD is gold. Inflation, the Fed doing all that they're doing, all the crazy stuff. I like to be diversified a little bit. So gold, this is a long position, and it's going up. That means that my call was 182, which was already in the money. So that means my strike price was lower than the current because this is a call. 182, right now the price is 186. So I have $4.23 of intrinsic value of this 10. So that kind of shows you that there's $6 of time value in this contract right now. Okay, so I own these. So if I was going to close out the position and lock in my profit, I would sell to close these contracts. The Cisco one, if I wanted to get out of that, I would buy to close, because since it's a minus, that means I sold this contract. Okay. So June 16, September, another long-term call. My Pfizer, that means that the price has gone down, so my call has gone down. Here's my SPXUs. Now these expired today. Okay, you'll see that I have almost all the value in them. $13 and $13.50. Now I'm going to trade these because I want to roll these forward actually. And right now it's $13.53. So you can see that I sold these. So the idea is that you hope that they expire worthless. Right now, one's worth a penny and one's worth 3 cents. The $13.50 is worth 3 cents. So I could just let these go, and as long as SPXU was over $13.50, then these would expire worthless, and I'd keep the full amount, $180 and $82. I'd keep that. But what if the market turns around later today and or actually keeps going the way they are? Because these are my bullish, my bearish positions, right? So what I'm going to do is I'm going to roll these actually. So E-Trade has this really nice thing right here. I click roll. So what I'm going to do is I'm going to close the current contract, and I'm going to I want to sell next week's. Okay, and the current price is $13.53. So I'm going to buy to close. Remember, I sold these before, so I want to do the opposite. So I'm going to buy to close before then I'm going to sell to open the next week contract. Okay, and they're puts, right? And so what this does is this is called a spread, and you put in a price based on the difference between, because I'm going to sell, I'm going to buy this one back, and I'm going to keep the money, but then I'm going to turn around and spend some, I'm going to sell to open, and that's going to, I'm going to get some more money. So first I have to buy it, so I have to pay a penny, like 2 cents. You can see right here, 2 cents. And then when I sell to open, it's going to be 11 cents. But I want to go up to the $13.50. When I'm selling options and I want to get into a position, I pick strike prices really close to the current price. Okay, so current price is $13.53, right? I pick a $13.50, so I'm going to buy back my 13, and I'm going to sell next week's, right? 1 week away. I'm going to sell that, and you'll notice I'm going to get around 32 cents I'm going to make like 32 cents per contract, right? And I'm doing 2 contracts. Okay. Good for the day. I need to do this right now. It needs to execute today. So preview the order. All looks good. Place the order. Okay. And let's go back to the accounts. I'm going to go into a different view. I like this trading tool a little better. So we'll see if that one, that trade went or not. Okay, we're going to do most of the other trades in this one. Okay, I've done that. Don't show me again. All right, so if we go over here, SPXU multiples, I have, okay, so you'll see I have 2 of them for May 12th. That's next week. So that trade worked already. Okay. So what I want to do is I want to roll. Okay, if I can figure this out. One of these is roll. Okay, what I want to do is, maybe I'll go back to the others. I got to figure that one out. when I have two positions of the same thing, it becomes that one becomes a little harder. So let's go back over here. We'll do this again. So you can see my 12th of May. So that one rolled forward, and I need to roll this other one that's going to expire today. So I'm going to roll that guy. So this is a 1350 strike. So this is really interesting because the current price is really close. Look, 1353, and my strike is 1350. But I have most of the value. I've made most of the money on this, but I haven't made all the money. Now I could wait and later in the day and hope that the price stays above my strike price. But I don't like betting on that. So I'm just going to roll this forward. So I have to buy it for 10 cents. I'll sell it for 33 cents, and I have 3 contracts. Okay. So my net, I'm going to net about 23 cents per share. Okay. All right. So look at this. Just make sure I buy to close the ones I already own, and I'm going to sell to open next week. And I'm using the 1350 strike, which is really close to the current price. Okay. Place the order. Let's go back and look at our, should have looked at the portfolios. Let's go back here. Everything's loading. All right, so hopefully that trade went through. Let's see. Okay, yeah, see I have 5 now because I picked the same strike. So that's easy. Now my TLT trade right here. Okay, so if I jump back over here, TLT right there. I want to place a trade. The quote, options chain, chart. Okay, so let's just jump back over here. TLT. What's the current price? My strike is 105.50. So what's the current price? 104. So right now, if I didn't do anything and the price stayed the same, I would get put 100 shares of TLT after the market closes today, because the strike price is below my current price. And you can see that I'm actually in the hole, right? I'm a little bit in the hole. This is my gain altogether. Last price change, percent change, total gain. I'm still ahead though, right? See, my option, remember when I first sold this option, a lot of the value was the time value. Now right now there's no intrinsic value in there, right? In fact, it's negative intrinsic value. The difference between my 105.50 and so like $1.12. So minus $1.12 intrinsic value. I got $1.79 for it when I sold it. So I've made the difference. I made the 52. So I'm just going to close this. I don't want to roll it out. It's tying up when you sell options, especially in like in an IRA account or something. They're called cash secured puts, and you have to have enough money to cover this, right? This would cost, if I did nothing and the price was below 105.50 at the end of the day, they would take $10,550 out of my account and buy me 100 shares of TLT. And I don't want to do that. I don't want to buy 100 shares of TLT right now, okay? So I'm going to close this position. I have one contract. Again, I'm buying to close because I sold it originally. I'm going to buy to close it. It's a put. I'm going to pick a limit. I'm going to limit order. I don't like to do market orders because there's market makers out there and they manipulate prices in the short term. And so I don't like that. So you can see the bid and the ask right now is 114 to $1.14 to $1.19. So I usually pick a price in the middle, $1.16 per share. Now this is really important because this is one of the places that you can mess up and it will cost you a lot of money. Okay, so I'm going to buy this and I'm willing to pay $1.16 per share. This would be $116 for one contract. Now if I put $10.16 in here, it would for sure go through. Somebody would love to get $10.16 per share for this contract, and I would just lose $900. Okay, so this is why you want to take my advanced options course. Okay, because you need to make sure you do this properly. Because one little mistake like that, one digit, that if I did that right here, it would cost me almost $1,000. I'd lose the second I click the order button. Okay, so anyway, please pay attention. Right, you can see right here what the current bid and ask is for this contract, and so you want to be between there. Okay, so I want to do it. Needs to happen today because this contract expires today. So preview the order. I get one more chance to make sure. The last trade was $1.15. Okay. Now this brings up another really good point. You want to have permission. You want to have live market data when you're doing options and even stocks. Okay, because most of the time people don't realize most of their accounts are delayed data. They have data that's up to 15 minutes old, and you're trying to do trades, and it's weird. You'll put in a trade and you'll set a price, and it doesn't go through, and you wonder why, because you put it like right at what you thought the market was right then, but you're actually looking at 15-minute old data. Okay, so you want to have live data. So this was the last trade, and I'm trying to do it for $1.16. So I'll place my order. So somebody paid me $1.79. I'm going to pay $1.16 to get it back. So I make the difference. What's that? 63 cents per share. Okay. So not a lot of money. I make 60 bucks if this goes through. So let's go look and see if it's gone through yet. If it hasn't gone through, I need to adjust my prices. Okay. So let's see. TLT, it's gone. So it went through. I made my 63 bucks, right? Now TQs, they should be going up actually. Current price 27.43. 27.43. My call is my put was 27, so I won't get put these as long as the market stays up. Okay, they're still worth 9 cents, and I only got $1.24. I'm going to watch this throughout the day, because if the market stays up today, these will expire worthless, and I'll get to keep the whole $1.24. If the market turns around and the price starts to go against me, then I'm gonna get out and lock in my profit. But I'm just gonna watch this throughout the day. So basically that's it for today. We've kind of gone over everything, a lot of stuff. Again, all these videos are for educational purposes only. I'm not recommending any of the positions. I'm just showing you real live trades. So anyway, please subscribe to my YouTube channel and have a great